So Chapter 13, we're going to talk about the financial performance measures that you use in accounting to help you as a individual being a manager, where they're analyzing the business to determine whether or not the business is doing well or how it's performing compared to itself historically and compared to its competitors. So our learning objectives for Chapter 13 are to describe the objectives, standards of comparison, and sources of information in measuring financial performance, define the quality of earnings, and identify factors that affect the quality of earnings. Then we're going to look at applying horizontal, trend, and vertical ratio analysis, and we're going to look at doing other types of ratio analysis to evaluate financial performance of companies. Our first objective. Basically look at the standards of comparison and sources of information for financial performance measures. Okay. So, the foundation of financial performance measures is basically that we're going to use it to help us analyze how items in a company relate to each other and help us to determine whether or not we're meeting our financial objectives for the company. Financial performance is important to both managers and employees, and also to creditors, investors, customers, taxing authorities, both internal and external users. So we learned back in Chapter 1 that our company has two primary goals, profitability and liquidity. And management's goals relating to financial performance measurement should include some financial plan employing or using or achieving those financial objectives. So the profitability measure, the idea would be the company wants to earn a satisfactory net income. In terms of total asset management, the company wants to use all of its assets in a way that helps to maximize its financial performance and investment. And in terms of liquidity, they need to be able to pay the bills when the bills are coming due. They can't pay them late, so they need to know what their cash expectations are and what their cash uses are. They also have to know about financial risk in order to make sure that their debt is being effectively managed. They want to make sure they're not taking on too much debt and that they're paying their debt in a timely fashion. And then lastly, from an operating asset management standpoint, they want to make sure that they have current assets available to pay off current liabilities. So, from an internal user perspective, they also need to know about the financial performance objectives in order for management to determine compensation. So there are managers within companies whose compensation packages are tied to the financial performance of the company. So they use those measures to determine whether or not the company's managers are going to get maybe whatever bonuses that they're targeting to get. Okay, so as you go higher up in management, and even nowadays, they look to try to tie financial performance measures to even middle management level people, with the idea being that if you are more vested in how this company is achieving its financial performance targets, then if you're going to be rewarded for it, you're going to be more likely to try to achieve those targets. Okay, so like even as like when I was leaving the corporate world, 15 years ago, that's what we were starting to do. We were starting to put into place like compensation packages for like middle level managers, so that they would be more vested in trying to achieve the objectives of the company. Under Sarbanes-Oxley, the Sarbanes-Oxley Act that we've talked about a couple of times, part of the challenge that you have when a company's management team is tied to the performance objectives of the company. Sometimes there's a little a downside in that there's a bad incentive. So some companies, their management teams, in order to make their financial objectives, they might do unethical things, so that they would be rewarded. Okay, and so under the Sarbanes-Oxley Act, it sought to try to take away some of those incentives because the independent auditors have to come in and sign off that they are in adherence with the law, that they're not doing anything unethical, and the top executives have to also sign off on it. Okay, so they're held not only from a corporate standpoint liable, but they're held personally liable if they defraud or if they're unethical in their financial reporting for the company. And then the company must also now disclose the components of the compensation packages for those higher executives. So they have to outline what the base salary is, if there's any sort of stock incentives or incentive bonuses. And they they use a lot of those compensation packages to reward the executives, and they have to be filed and reported to the Securities and Exchange Commission, the SEC. So, some of our external users of financial performance information are clearly creditors, investors, okay? So when you go and you look at investing in a business, you should be looking at some of these financial performance measures to help you to determine what the possibility of their success is. If you're not familiar with how a company is doing, it's probably not a good idea to go and invest in them because you really don't know what's driving, whether they're doing well or they're doing poorly. So that's part of what your whole project is about, to try to help you guys learn what some of those things are that you're going to check into and evaluate as an investor, so that long term when you guys go and invest in stock, and also when you go to work for companies, you know what you're looking at. You don't want to work for a company that's going to go bankrupt in a short period of time. So they use financial performance to help judge the company's past performance, get an assessment of what their present position is, and then hopefully give them an idea as to what the future potential is for the company. From an investor focus, they're looking at the company's earnings potential and their ability to improve the stock's price, and whether or not the company is going to give dividends or not. From a creditor standpoint, as a creditor, you want to just know that they're going to be able to repay you. Do they, historically have the ability to manage their cash flow to be able to repay their debts in a timely fashion? And what do we think going forward? So, some of our standards of comparison that we use in evaluating companies, we use what we call, first standard of comparison is what we call rule of thumb. God bless you. And with rule of thumb, we're trying to basically assess, generally speaking, is this a good measure or not a good measure? So some ratios that you might look at are their debt to tangible net worth and their working capital. Okay? So you want to see what those numbers look like, and some rules of thumb. I think I've talked about, like with your current ratio, a rule of thumb is you want to see your current ratios typically over 1-to-1, meaning their current assets cover their current liabilities on a 1-to-1 basis. Okay, same with their tangible net worth or debt to tangible net worth. You typically want to see it under 1. Here it says 0.8, but typically under 1 is a good measure. But these are different depending upon the company and the industry. Okay, if you were looking at like a leasing company or a finance company, their working capital, their current liquidity is not typically going to be 1-to-1. It's going to be somewhat less. Same with their debt. Their debt to net worth is probably going to be higher than 1. That's just the way that those companies operate. So you can't just look at them in isolation. The rules of thumb you should know, but you should also know, like as you get into evaluating an industry, some rules of thumbs that are industry specific. You also look at the company's past performance over time. And then you're going to look at, like I said, the industry norms. Compare your company to other industries. It's harder when you get into a diversified company. So if you look at like a GE. GE is what we call a conglomerate. They don't operate in just one specific industry. They operate in lots of different industries. They have their turbine businesses. They have their GE Capital Finance businesses. They have, household appliances, so consumer goods. So they operate in different industries. And so as a conglomerate, it's very hard to look at them as a whole and say, how do they compare to other companies in their industry? Because there probably is no other company in the entire world that does exactly the different types of things that that company does. So a lot of times you might have to look at the sub-companies within a conglomerate. So how is the turbine company doing? How is the consumer goods company doing? Et cetera, et cetera. So some of the limitations to using industry norms. No two companies are the same, as I just mentioned. And diversified companies operate in unrelated industries, so making comparisons is difficult. The last thing, which is kind of important, is different companies use different acceptable accounting practices. Okay? So when you're evaluating companies, and we'll get into this in later chapters, they may not necessarily compare 100% to other competitors if they use different acceptable accounting practices between them. So for instance, later on when we get into our inventory evaluation and analysis, so if one company uses what we call a LIFO inventory valuation method, last in, first out, their assets for their inventory levels are going to be different than a competitor who might use a FIFO, first in, first out inventory valuation. So just those two things in and of itself can change what their profitability looks like because of the valuation of the cost of goods sold, as well as their inventory levels, which is going to change their current assets and their liquidity valuations. So things like that, you have to, as you get more sophisticated in your financial analysis, you'll understand how those different accounting practices might affect the companies and how their financial statements look. So, some sources of information about public companies. So how can we find out how our companies compare to each other? We look at sometimes reports that are published by a corporation, their annual reports, their interim reports, quarterly, semi-annual. So that's one way to find out information about public companies. Another way is to read the reports that are filed with the SEC. That's a lot of what you guys are doing. Annual reports, as you know, are 10Ks. Quarterly reports are 10Qs. And then the current reports are called Form 8Ks. And then lastly, we can use things like business periodicals and credit investment advisory services. So business periodicals, those are some of the things that I've had you guys go on to, like with that Business Insights website, or going on to oh my gosh, like the Street.com reports or the Reuters reports or any of those different types of reports. Those would be different types of business periodicals that you could use to help you to evaluate your companies, okay? And then two very big companies that you guys should become familiar with are Moody's and Standard & Poor's. Moody's and Standard & Poor's are, and they're great companies to work for too, if you're looking for jobs later on when you guys graduate, if you graduate with finance degrees or economics degrees. Really great companies to work for. They basically evaluate all these different publicly held companies, as well as municipalities and government agencies and the like, and they give them ratings in terms of what they perceive their ability to. So in Objective 2, we're going to start out by helping to define the quality of the earnings for a company and the factors that affect that quality of earnings. So in evaluating the quality of earnings, we have to look at the net income figure and not only understand that they achieved a net income, but understand where that net income came from. And so we're looking at both the substance and the sustainability of the future earnings. And a few factors that affect it are the accounting methods, accounting estimates, and then one-time items. Now, the reason that I say that is because we want to look at and understand all the factors that go into what the components of earnings are. And if you remember, last week, I had mentioned to you guys with regard to when we were preparing a multi-step income statement. I had said to you, we want to make sure when we use a multi-step, one of the benefits of it is really being able to differentiate where our net profit is coming from. So, for instance, you want to know that your profit is coming from your operations as opposed to those other non-operating sources of income, whether it be interest income or gain on sale of an asset, things of that sort. So you want to know what your components of your net profit are, okay? Because you would not want to have your net profit coming from non-sustainable items. So you want to evaluate the quality of your earnings, and factors that affect the quality of your earnings are things such as your accounting methods for your inventory. So determining whether you use a LIFO inventory method or a FIFO or a double declining balance depreciation method. The LIFO method tends to lower the operating income during an inflationary period, and we'll learn about that when we get to our chapters on inventory. Same with the double declining balance. It will lower the operating income during the early years that the items are being depreciated. And then the factors that affect the cash flow and the interpretation of the financial statements. Secondly, using accounting estimates. So for instance, last chapter we talked about, in chapter 3, we talked about depreciation. And just changing the depreciation method or the depreciation number of years, the useful life of the asset, will have an impact on your earnings. You also have to look at things that are one-time items, like I had mentioned, gains or losses on sales of assets or long-term investments. Also, if you have to write down the value of anything, if you have to write down the value of your inventory, if you have to write down the value of your receivables, those will impact your income statement. And then if you have to do any sorts of restructuring. And then things that are what we call discontinued operations. So if a business, they decide to stop operating a segment of their business, they have to, go through the process of shutting everything down and then discontinuing that operation and writing anything off. So, in looking at a corporate income statement, we want to focus on and know that our sources of our profitability are coming on a routine basis from our income from operations. Okay, we have all of those discontinued items. And we can see here they're relatively small on a net basis compared to what our income from operations is. You really don't want to see discontinued operations or unusual items be a large portion of your profitability. And if they are for a particular year, you've got to understand why. I think there was somebody whose income statement whose income statement had a big number in an non-operating revenue category? Somebody, was it Kellogg's, Jimmy? Was it you guys?
I think so.
Somebody had a really large, a significant number in their non-operating revenue, and I said we need to know what that is. You know. Okay. So we're not going to do this right here, right now. This stop and apply, because we're going to do a couple of problems right now. Okay. So if we can take out our worksheets, that would be great.